What if I told you that every single country on Earth is trapped in a financial system designed to benefit one nation above all others? This isn't some conspiracy theory. It's the most successful empire in human history, and it operates without armies, without occupation, without conquest. Instead, it uses something far more powerful and far more subtle: the simple act of making itself absolutely necessary for survival. Welcome to the hidden empire of financial control, where dependency is manufactured and nations become willing participants in their own wealth transfer. To understand how this system works, we need to grasp a fundamental truth about human psychology and economic behavior. When something becomes essential for your daily operations, you don't question it. You adapt to it. You build your entire life around it. This is exactly what happened with the global financial system, but the story begins with a carefully orchestrated crisis in 2026. After World War II, while most of the world lay in ruins, one nation emerged with its industrial capacity completely intact. This wasn't just luck. It was geography, timing, and perhaps most importantly, the foundation for the greatest financial empire ever created. At Bretton Woods in 1944, the world's financial leaders gathered to create a new monetary system from the ashes of war. But this wasn't just about reconstruction. It was about creating a system where one currency would become the center of global trade. The dollar was backed by gold, which gave it credibility, but more importantly, it was backed by the only major economy left standing. Other nations had no choice but to accept this arrangement. Their economies were shattered, their currencies worthless, their options limited. This psychological principle of manufactured necessity would become the cornerstone of financial control for the next 8 decades and counting. But the real genius of this system wasn't revealed until 1971, when Nixon made what seemed like a catastrophic decision. He severed the dollar's connection to gold entirely. No more backing, no more convertibility, no more physical anchor to reality. The world was now operating on pure fiat currency, backed by nothing more than trust, habit, and critically, absolute dependency. Most economists predicted this would destroy dollar dominance. Instead, it was about to become more powerful than ever before. Because 2 years later, in 1973, a crisis emerged that would hand America the ultimate financial weapon on a silver platter. The oil embargo of 1973 wasn't just about politics or regional conflicts. It was about leveraging the most essential commodity on Earth. Oil wasn't just fuel. It was fertilizer, plastics, chemicals, transportation, electricity, and the foundation of modern industrial civilization. When oil-producing nations suddenly refused to sell, the global economy experienced what economists call a supply shock of unprecedented magnitude. Prices quadrupled overnight. Inflation spiraled out of control. Gas lines stretched for miles. Western economies teetered on the edge of collapse. But instead of succumbing to panic, American financial strategists saw this crisis as the greatest opportunity in the history of monetary policy. They approached Saudi Arabia, the largest oil producer, with a deal so elegant in its simplicity that it would reshape global finance forever. The agreement was straightforward. Saudi Arabia would sell oil exclusively in dollars, and America would provide military protection and technological support. But the psychological genius of this arrangement went far deeper than a simple bilateral trade agreement between two nations. Because once the largest oil producer committed to dollar-only sales, every other producer had to follow or risk losing market competitiveness. This created what economists call a network effect, where the value of participation increases as more participants join the system. Suddenly, every nation on Earth needed dollars, not just for trade, but for the most essential commodity required for economic survival. This wasn't just about energy anymore. It was about psychological conditioning on a global scale, creating dependency disguised as convenience. Countries that previously might have developed alternative trading relationships now had to maintain substantial dollar reserves at all times. Think about the psychological impact of this arrangement. Every economic decision now had to factor in dollar availability and dollar stability. Countries began structuring their entire economies around maintaining access to dollars, rather than developing independent financial systems and relationships. This created what behavioral economists recognize as a dependency spiral, where each accommodation makes the next accommodation feel more necessary. But the most brilliant aspect of this system wasn't the initial capture mechanism. It was the recycling loop that made escape virtually impossible. Oil-producing nations suddenly found themselves with enormous quantities of dollars flowing into their treasuries every single day of the year. These dollars couldn't just sit idle. Inflation would eat away their value, and economic pressure demanded productive investment of this massive capital. But where could oil producers invest trillions of dollars safely and profitably? The answer revealed the true genius of this financial architecture. American government bonds offered security and liquidity. American stocks provided growth potential. American real estate promised long-term appreciation and stability. This created a recycling mechanism where oil dollars inevitably flowed back into the American financial system, strengthening it exponentially over time. The psychological impact of this recycling loop cannot be overstated. It transformed temporary necessity into permanent psychological and economic dependency. Nations that initially participated out of necessity now found their entire economic infrastructure built around maintaining and strengthening these dollar relationships. Central banks stockpiled dollars as reserves. Commercial banks developed dollar-based lending systems. Businesses structured contracts around dollar stability and availability. This institutional embedding created what systems theorists call path dependency, where changing course becomes increasingly difficult and economically dangerous over time. By the 1980s, this system had evolved beyond mere economic convenience into something approaching financial gravity, affecting every transaction on Earth. The United States had achieved something unprecedented in human history: economic control without conquest, financial dominance without military occupation. Countries that might otherwise challenge American interests found themselves economically invested in American success and stability rather than pursuing independent paths. This wasn't just clever policy. It was psychological warfare disguised as mutually beneficial trade relationships and economic partnerships. The beauty of this system lay in its apparent fairness and mutual benefit, masking the underlying asymmetry of power and wealth accumulation. By the 2000s, attempts to create alternative systems faced not just American resistance, but resistance from nations dependent on dollar stability. Countries like Germany and Japan, despite their economic might, found their interests aligned with maintaining rather than challenging this dollar-centric system. This created what economists call a coordination problem, where individual rational behavior maintains a system that might be collectively suboptimal. Even countries with reasons to resent American influence found themselves trapped by the logic of economic necessity and institutional momentum. The 21st century brought new challenges as digital currencies and alternative payment systems promised to disrupt this carefully constructed financial architecture. China's rise as an economic superpower presented the first serious challenge to dollar dominance since the system's inception in the 70s. But here's where the psychological conditioning of 5 decades becomes apparent. Even China's challenges work within the existing system rather than replacing it. China reduces dollar dependency selectively in areas where political necessity outweighs economic convenience, but maintains dollar relationships where beneficial. Russia's attempts to escape dollar dependency through sanction-driven necessity reveal both the possibilities and limitations of challenging this financial empire. The yuan, despite China's economic might, still represents less than 3% of global foreign exchange reserves in 2026. This isn't because alternative currencies lack technical capability or government support. It's because changing systems requires coordinated global behavioral change. The switching costs aren't just financial, they're psychological, institutional, legal, and operational, accumulated over decades of system integration. Every bank, every business, every government agency has procedures, contracts, and relationships built around dollar-based transactions and dollar-denominated assets. Changing currencies means changing software, rewriting contracts, retraining personnel, restructuring relationships, and accepting transition costs and risks. The network effects that made dollar dominance possible now make dollar replacement extremely difficult, even for nations with strong motivations to change. This is why even cryptocurrency enthusiasts and blockchain revolutionaries largely price their innovations in dollars rather than creating truly independent systems. The psychological infrastructure of dollar dominance extends beyond economics into culture, education, and fundamental assumptions about how global finance should operate. Financial professionals worldwide learn systems, models, and frameworks built around dollar-based assumptions, making alternative thinking psychologically difficult. This creates what cognitive scientists call mental model lock-in, where existing frameworks become so familiar they're mistaken for natural laws. Understanding this system isn't just academic curiosity, it's essential knowledge for anyone serious about understanding global wealth flows in 2026. Every investment decision, every currency choice, every international business relationship operates within the context of this carefully constructed financial architecture. Smart money doesn't fight systems this deeply embedded. Instead, it understands them, anticipates their evolution, and positions accordingly for maximum advantage. The future won't bring sudden collapse of this system, but gradual evolution as technological alternatives slowly create new pathways for capital flow. Successful investors and institutions will be those who understand both the persistence of existing systems and the emergence of alternative financial architectures. This is the hidden empire that shapes our world, not through force, but through necessity, not through conquest, but through convenience. Understanding this system is your first step toward financial literacy in an interconnected global economy where knowledge truly becomes power. If this deep dive into the hidden mechanics of global finance opened your eyes, you need to stay connected with shadow economics. We're peeling back layers of financial systems that most people never see, revealing the true mechanisms that control global wealth and power.
Subscribe now because understanding these hidden systems isn't just interesting, it's essential for anyone serious about building and protecting wealth in our complex world. Join our community of financially aware individuals who understand that true wealth comes from understanding the systems that others take for granted.